Can you sell your home with the mortgage still there? Hi, I'm Amol Heda with Keller Williams Bay Area Estates, an author of Thriving Through Ownership. So this is a very common question, and actually if you're working with a professional, this should not even be a question, because 70% or more of properties are sold with a mortgage, and they probably even had a mortgage on them. That's how the industry works. So if you're working with an agent, with a title company, and or your attorney, this should not be a question. But let me explain exactly how that process works. So let's take an example of a Bay Area house that was sold in 2014, 10 years back, for $1 million. The buyers bought it with a $800,000 mortgage, and they paid about $200,000 in down payment. Today, after 10 years, the home appreciated to say $2 million. So, and during the 10-year period, typically, about a 25% of the mortgage gets paid off. So if it was $800,000 in original mortgage, they probably were left now with about $650K of mortgage. So when you sell this property, say for $2 million, so the first 650 will go to the lender, because they funded you, seller bought the property. And now when you're selling, the first person to have the money, or that is what is called as the first lien position, they get themselves paid first, and that's $650,000. I'm just taking it as an example, concrete numbers for each individual case. So once that money is paid off, only then they can pay off all the others. But typically, when you are in escrow, the way the escrow works is, first the costs of the escrow are paid, like closing costs, the brokerages and everything. Then the first person that gets entitlement to the money is the lender, or that is called as the first lien position. Suppose there were two loans or two mortgages on it, first and second, or first loan or first mortgage and a line of credit, then the first mortgage gets paid first, and then if there is something that remains, would go to the second. Now suppose this particular owner were to borrow a line of credit which increased their loan from $650 to say $1 million, because their home went up to $2 million, that second position would get paid, and then the remaining $1 million would come to the homeowners. So that's how the typical process works. But remember, every transaction is different and every position is different. Because every transaction is different, now suppose there was a short sale, suppose the home lost value and it is now left at only $900K. The closing cost would be gone, say $50,000. $650 of the lender's amount would be gone, so $700,000, and the $200,000 remaining only would come back to the seller. But now imagine that this transaction were to be like the property lost value to the extent of even $500,000. So then what happens? The closing costs go out first, then the remaining, so suppose the $50,000 are the closing costs, they are gone, taken away first. Now out of $500K, 50 is gone, $450,000 goes to the first lien position. The second lien does not even get anything, and the seller of course lost their entire money. These are the typical situations. There are more complex situations like divorces, trust sales, probates. Each story is different, and so while it might not seem very complex, It is very simple, but these individual stories or individual cases need different handling and expertise. That is how you close transactions. I hope this was useful. And if you found it informative, please like, click on the thumbs up button, and share with people that you may need this advice. Thank you for watching. See you on my next one. Bye.